So let's talk about this everything bubble. Let's talk about what the Federal Reserve had to say yesterday. So Chairman Jerome Powell speaking yesterday about where they intend to go with interest rates. We got some new data out this morning before we get to Chair Powell, on the economy. So if you're curious, like how is the economy in general? This just came through a few minutes ago. The U.S. economy grew 5.7% in a pandemic last year. That's the fastest full year since 1984. So the economy's booming and, just doing just fine, I guess. Labor participation is through the roof. Wages have gone up. But of course, growth is incredibly uneven, right?
Yes.
Because you have so many people who've left the job market altogether. And you have, yes, jobs being created, but there's a massive imbalance because we have the price of goods skyrocketing as well. So just about everything that you pay for has gone up. Rent is probably the most egregious in this entire mix right now.
Rent is up 18% from this time last year, despite the fact that wages are not up. You may have noticed in the newsletter also, Deutsche Bank reported fourth quarter earnings, and they had their best year of profit
ever
in 10 years, in over a decade. Okay. Right. So there, you can see is exactly who is booming and who is busting, especially when you consider your own shopping habits, right? Where are the places that you are still able to rely on? Target, Walmart, Amazon, Home Depot. As we see earnings continue to be reported, Tesla still doing just fine, although Elon Musk says now the supply chain has affected the Cybertruck. So they're pushing that back to 2023 because he says there's no point in releasing it when we can't actually make it. So you see these decisions being made, but not actually affecting anybody's bottom line because business is still there.
So Federal Reserve Chair Powell, yesterday, all eyes in the markets were on what he was going to say yesterday about these interest rates. What is the Fed going to do? And there's a lot of people that say they are in quite a pickle right now. They've really boxed themselves in. On the one hand, you're trying to keep interest rates at about 2% or inflation at about 2%. At the same time, you have a balance sheet that has about $8 trillion of corporate junk bonds and all of this crap on your balance sheet. Wall Street is doing really well. You've painted yourself into a corner right now. What is the Fed actually going to be able to do? I don't know. I don't know if they're going to be able to drive down inflation, but also make sure that we don't enter a massive recession at the same hand.
The remarkable progress we've seen in the labor market and inflation that is well above our 2% longer run goal. The economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate.
So that's what Fed Chief Jerome Powell had to say.
Yes, that. Mm-hmm. It was a lot of damned if you do, damned if you don't. Can I say damn?
Sure.
Okay, I said it. It did feel like he needs to do it because we continue to live on a stimulus of unnaturally low rates, but he doesn't want to do it because we don't want to contract the economy. And it's funny because the words he said seemed very pacifying. He was like, not yet, it's coming, it's okay, the economy's good. So the market was really skittish on anticipation of his words. And then despite the calming words and the no action, the market is still quite skittish.
Right. It'll go down in history books. He said let's see here. In the Fed's words, with inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate. We're probably going to go down, basically hike interest rates after our next meeting in March. And the question then is, well, are you going to continue to raise rates at every meeting throughout the rest of the year? There are those that say, yes, this is something that they should be doing regularly throughout the rest of the year. But, if you think about these conversations, they all seem to be untethered from reality because if the Fed raises interest rates to 4%, that raises annual interest charges on a $30 trillion debt for the United States that we have. We're $30 trillion in debt. That raises that debt by that just the interest payments alone to $1.2 trillion. Think about that. So the amount of extra interest we're now paying on this debt that we can't afford. How is the Fed going to fund that enormous increase? Right? They're going to have to come up with this money in government spending to cover the additional interest and debt load. Makes no sense. So just if you're following along at home, more debt equals more money printing equals more inflation.
Right. equals more expensive debt, not just for you, but also for the government. Now, the National Treasury released its report for 2021 expenditures, and it shows that our debt payments, what we actually just pay in, let's say, net interest right now is already $42 billion a year. That's more than we spend on veterans benefits. That's more than we spend on education. That's more than we spend on transportation and other things. So it's kind of hard because it will affect, the Fed is going to affect its own budget. And clearly they don't want to, but what they also don't want to do is let inflation continue to run amok, hurt the average person. They do seem to care about not doing that to some extent.
But if you think about just in general how the Fed right now has been a prisoner, they've been a prisoner to 20 years of this monetary policy of keeping interest rates at near 0%, because if the federal government is allowed to go $30 trillion in debt and they are artificially continuing to pump this money out so that the government can run these massive debt problems, they have created this problem.
Yes.
And now they're going to somehow try to put this cat back in the bag, the horse back in the barn.
The horse back in the barn, yes.
How are they, it's not going to end well for them. So I think in these situations, we need to be looking at ways, where are areas right now that we can invest, be smart with our money that are outside of these inflationary pressures, things that, like gold, like silver, looking at precious metals, looking at real estate, looking at, frankly, stocks that are not tied to this inflationary pressure that actually stand to benefit from higher inflation. I mean, I hate to say it, but banks, look at Wells Fargo, look at Citigroup, look at Goldman Sachs, like looking at these types of stocks right now, these bank stocks that are actually going to do well over the next year and continue to put in positive returns, pay out dividends. So this is, time to get smart with your money.
Yes. I mean, recall Ben Bernanke really did not want to do this. He was the last holdout of Fed Reserve chair. And once he was pressured into doing it, it's been a runaway train. And this is exactly where we are right now. So if you are looking at your finance and your balance sheet, you need to think about, can I secure, these are my last few weeks to secure some kind of very low interest loan product. Can you get a line of credit that's locked in at this low rate? Can you get a home equity line of credit on whatever equity you gained in your house? Can you get some kind of business loan? Now's the time to do it because it's going to cost you more. And then maybe later you can just put it in place as a holding pattern. I don't know if that's your options or not, but it's speak now or forever hold your peace.
Right. And, I should not to be all doom and gloom, because if you look at analysts' way they think on this, it's like, okay, we go through these periods of ups and downs. This is not 1987 crash. This is things go up, things go down. Look, we had a crazy market in the spring of 2020 during the pandemic. This might not be that bad from an overall market collapse perspective. There are people who are saying, look, we've been through this before. It's not time to panic. It's just time to be smarter. Because the people that panic, I think, end up getting screwed in this situation. You suddenly sell everything that you have.
Yes.
Sell everything that you have, but nothing really has changed in the past few days, right?
Yes.
Nothing really fundamentally has actually changed since like this past week, right? I mean, nothing. The Fed is going to maybe raise rates in March. That hasn't happened yet. So really, at the end of the day, nothing has actually happened.
Well, government spending has slowed down because of congressional opposition. And that government spending that we had in the first year of the Biden administration, where he just went on a shopping spree, has resulted in inflation. And now we are sort of trying to figure out how to react to it. But you notice then that these stimulus bills, these pieces of government spending, are now coming through in a smaller way because we are now going to hit the debt limit once again in February.
I love how we go through this like every few, we continue to go through this like every few weeks. Like we kick this debt limit thing down the street, and then the Federal Reserve has to come in and say, yeah, we need to raise the debt ceiling again. Let's just crank it up. Just keep going further into debt.
Well, when was the last time the federal budget was balanced? Under Clinton.
Under Clinton, 1994, I think, 1993, 94.
And some economists say that it was because nobody would spend anything. He also had a locked Congress and could get no bills passed, so government didn't spend. So the budget was balanced. That is not the appetite right now. Everyone wants the government to spend. Right. So I don't think we're getting anywhere close to that.